Thank you so much, Lalit. Thanks for the very kind introduction. Thanks for inviting me to share my knowledge and expertise with this community. And I'm very happy to discuss and then have like a collaborative discussion here with intellectuals like you guys, because I think as a strong believer of the cryptocurrencies or the digital currencies, I think it's very important and it's very paramount for us to raise the awareness and get the like-minded people into a same, I would say, like same boat. So then obviously we would be able to achieve certain things for greater goods. So that being said, let me start my presentation. So what I would like to tell is, I'll go through my present. You guys can see my presentation, right? Like, can you see the presentation?
Not yet, Manju.
Okay, 1 second, sorry. You can see it now, right?
Yeah, it's there.
Okay.
Right.
So I'll do my traditional presentation, but given that we have so many intellectuals in this, once I heard your introduction, it just triggers me it's better to have like a two-way conversations with you guys as well, given that you all are like intellectuals. So I would like to have like more like a two-way conversations as well, and I'd like to have answer a lot of questions that you might have. So I'll try to brief my presentation, because this could be like a very traditional, typical presentation for cryptocurrencies. But then obviously, given that you can understand and go through these things quickly, it's better to, I think, have like a two-way dialogue between us. So then obviously we can clear a lot of things, because you actually touched upon like various matters in the blockchain and the cryptocurrency space, and I think some of them I may not have covered in this particular presentation, but I would like to discuss those things under the Q&A session. If that sounds good.
Yes, Manju. Yeah.
Okay, perfect. All right. So cryptocurrencies. Before we getting into the history of the cryptocurrencies, let's, as a norm, just try to find out, what is cryptocurrencies, right? So in a technical term, cryptocurrency is a digital or virtual currency or digital currency, right, which is secured by a cryptography, right, which makes it nearly impossible to counterfeit or double spend, as you know. And almost every cryptocurrencies are decentralized. The reason that I said almost every, because there are certain cryptocurrencies that are not necessarily decentralized. There are certain centralized cryptocurrencies as well. But the majority of the cryptocurrencies are decentralized networks. And the technology is based on blockchain technology, as you may know already. In a very simple terms, if I were asked to explain this to my grandma, I would say cryptocurrency exists on the internet, and it does not belong to any government or any central institution, and does not controlled by any central financial institution as well, such as like central banks. It is not a company or a product. It's just a protocol, internet protocol. And it is a digital payment system that is shared good. And it is nearly impossible to counterfeit or double spend, and it is controlled collectively by the participant of the network. So that would give some sort of like a very simple terminology when I explain the cryptocurrencies to any person, like a 4-6-year-old person, who does not necessarily know what the cryptocurrency is. So before we go into details, I think it is very important to understand, why this cryptocurrencies, the whole thing called cryptocurrencies came into play, and what was the initial trigger, what was the main reason that the cryptocurrency has come into the mainstream markets. So as some of you may heard or know already, back in 2007 and 2008, in the US, the financial markets were very volatile due to the subprime mortgage crisis. That there were like a lot of bankruptcies started happening during those 2 years, and the entire financial banking system has started collapsing, including Lehman Brothers, Bear Stearns, etc. And within overnights, the companies or the banks that we thought are like AAA companies, which are like highly creditworthy companies, went bankrupt within overnight. And some of the banks actually came even within 24 hours, they just the banks who had like, like billions of dollars of liquidity within 24 hours, they lost their entire liquidity, and they even came and asked for government bailouts for hundreds of billions of dollars. I can remember like one particular example back in 2008. So back to back, the Lehman Brothers and Bear Stearns, they just collapsed. And then uh, after like within like 1 week, even like the Goldman Sachs came in and then said, if the government does not give us like $120 billion within next 2 days, obviously we have to file Chapter 11 bankruptcy. So it was like a very scary situation. And what scared the most was everyone thought, I mean, US dollar is the global currency, and everyone thought the banking system in the US never collapsed, right? So that was a perception that we all had throughout the globe, right? So once this thing happens, right? I mean, the entire world start like, I mean, this whole financial effect, it has become like a domino effect, and then throughout the regions, USA, Europe, and Asia, almost like every country, the entire financial system has collapsed, and there were so many problems start arise, like inflation, and then the unemployment, etc., etc. But then what happened was during this time, people like start questioning. I mean, okay, I mean, we thought US dollar is the holy grail, right? Everyone can, I mean, regardless of what your nationality is or what your country, I mean, we can trust the US dollar or US financial systems, right? But then when this thing happened, people like start questioning. I mean, if the US government cannot sustain or like control their financial systems or like save their financial systems, then what, right? Because I mean, as an institution, US financial institutions are the biggest and the strongest in the world. So then people like start questioning, and then people like start becoming like very desperate as well. And out of all these chaos, in 2008, there was a white paper started circulating in certain email addresses called Bitcoin. It was circulated by a mystery person called Satoshi Nakamoto. It was initially distributed among 200 plus recipients. And then he simply pitched a concept of having like a peer-to-peer payment system without getting any governments or centralized governing bodies to the financial systems. So that thing thought the timing was very right, because as I said, the most of the people who are interested in the financial systems and financial institutions, right? I mean, soon as this paper came in, they like start reading it, and then they realize that, okay, there's something behind it, right? Yes, I mean, through these financial collapse, I mean, we realize sometimes the centralized financial systems can be challenged, right? So in that case, what could be the alternative, right? So then obviously people like start realizing, okay, there's a truth behind it. So the whole white paper is about, as I said, about a decentralized peer-to-peer payment system in a very simple language, and it's called Bitcoins. And the underlying technology of this particular payment was blockchain technology. So in 2009, so I mean, during the entire 2008 year, right? People like start putting the codes and the suggestions together, mostly like the software developers. And then starting 2009, the whole Bitcoin software made available to the public, because what in the initial white paper, what they believed was, in order for this to become successful, this has to be decentralized and has to be public. It should not be governed by a private or centralized entity. So in 2009, as I said, the Bitcoin software became public and available for everyone for mining. Mining means, I mean, the way that we can generate and we can integrate these Bitcoin, Bitcoin currencies into our financial system is by doing the mining. Mining means, I mean, if you are a software engineer or like people who are interested in this particular coding, you know that in Bitcoin space, you just like, solve a very complex mathematic problem. And by doing so, you get rewarded by the Bitcoins from the network, right? So like that in 2009, it was open for mining. So people like start generating a lot of Bitcoins. And in 2010, Bitcoin actually it has got the valuation. I mean, it has that people like start putting the price against the Bitcoins, because initially there was no price for the Bitcoin. That people like start earning it, but then no one necessarily just like using it as a medium of medium of like payments. But in 2010, when it started getting the dollar value, when it's got pegged to the dollar values, then obviously it has got the prices. And starting from 2010, again, like, until 2012, it was not that very attractive, right? But the thing is, what we need to remember is like the whole purpose of creating this Bitcoin is to have an alternative to the US dollars, not to reject the US dollars or any centralized currencies, but to have an alternative when or if any financial crisis happens, people should have an alternative to save their wealth or their savings, right? So that was the whole purpose. If something like that happened, we have to have alternative asset that we can put our all the wealth and the savings, which is not correlated to the markets, right? So that was the whole purpose of the Bitcoin. So the fundamentals of Bitcoin is to have an alternative currency. And then this Bitcoin concept start like getting really popular, right? Among the mostly among the developers, software developers. And then start from 2011, right? All the other like the other alternative currencies also start appearing in the market. Things like Litecoin, etc., etc. So Bitcoin, even today itself, right? If you look at the entire cryptocurrency space, right, the Bitcoin is the Bitcoin dominates the market. But then obviously there are so many other currencies as well, which we call alternative currencies. But we start seeing the alternative currencies starting from 2011. And so Bitcoin prices start going up starting from 2010 and 2013. Actually, it went up to $1,000. I can remember that. And it came down to $100. Actually, I personally started investing in Bitcoin back in late 2012, I believe. I bought it for like $34 or something back then. And then yes, Bitcoin price crashed, and then again like it start going the upward momentum. And in 2014, the first Bitcoin ATM machine was launched in USA, in Kentucky. Actually, it's in Austin, Texas. And it is just like very similar to an ATM machine. You just like scan your ID, and the machine does the due diligence part, and then obviously once it is completed, you can buy your Bitcoin through that ATM machine, right? And then in 2014, when the Bitcoin started getting like mainstream, the US government has decided, okay, it's time for us to put some regulations, at least let's try to put some controls by putting some tax regulations. So in 2014, the IRS, Internal Revenue Services, actually announced that the Bitcoin has to be treated as a property. That means you have to tax. You have to the Bitcoin has to be taxed, which means when you have a capital gain, you have to pay the taxes accordingly. And by doing so, actually one good thing happened, which is like it actually gives the legitimacy for the Bitcoin, because until 2014 no one knew whether there's going to be a ban. The US government will intervene and ban this currency, or the something happened, and then obviously there's no such a legitimacy for this particular currency, right? But then soon as this thing happened, it's like start getting the legitimacy, right? And then once the US IRS has announced this thing, then obviously all the other countries in Europe and mostly in the Asia region as well, they also started looking into it. Some countries like Russia and China and India, obviously they couldn't bear that risk, and they were not ready to explore such avenues. So what they did was they outright banned the whole thing, but only for a couple of years, temporary, until they get their head around it. And in 2016, now the whole the cryptocurrency thing has became like a saga. It went out of control, right? And people like starting, through these other alternative currencies, like things like Ether and the other things. People like start putting putting all their new projects into blockchain. Everyone starts saying, okay, you can do everything in blockchain, which is absolutely, in my words, BS. But then obviously there were so many scammers came into market, and everyone like started raising capital for their projects through cryptocurrencies. What they did was, they just create a project, and then obviously in order to raise the capital, what they said was, okay, you know what, you can invest money in your capital into my project by buying the tokens that I issued, which are related or pegged to my project, right? So let's assume like very simple math. I'm gonna build a mobile app, right? And the valuation is $100. And instead of issuing shares of my company, what I do is I tell you, when I issue the shares, so you buy the shares of my company. But the whole ICO concept came into market with the project itself. So instead of selling the shares of my company, I sell the shares of that particular product or the project, right? So just assume the value of that particular product is $100. So I issued like 100 tokens. Each token's valued like $1. So investors would come and buy these tokens, and then obviously the investor has the ownership only for the project, and there's no recourse to the company. So then obviously the most of like a lot of scammers, took the advantage, because I mean, for these ICOs, initial coin offerings, there were no regulations anywhere in the world. So they just like, start like raising millions of hundreds of millions of billions of dollars. And there were like so many theft and scams happened during 2016. And then the government like started realizing, okay, now it's time to put some brake on it, right? So that's when actually in 2017, SEC, Security Exchange Commission in the US, has announced, if I will explain this one later, if your token behave like an investment contract, then obviously you have to treat this one as a security, which means you have to go through the Security Exchange Commission's security issuance process, right? So by doing so, they actually managed to put some brakes on it. And then obviously a lot of scammers, and then there are these like the people who are not real in this particular in this industry has within 12 months vanished. And nowadays you cannot find any sort of ICOs in the market that is happening in the market. And in 2017, the reason I'm talking about the Bitcoin is because the entire cryptocurrency is like absolutely pegged to the Bitcoin, as you can see, right? Even as of today, if you look at the entire cryptocurrencies market, more than 50% is dominated by the Bitcoins, right? So without talking Bitcoin, there's no point of talking cryptocurrencies, because whatever happens to Bitcoin, the entire market follows, right? So that's why I'm just putting this history for the Bitcoin's perspective, because everything else is pretty much same. And in 2017, the first Bitcoin hard fork happened. I will just bear with me. I will explain exactly what hard fork is. So that is something new. That was something new back then in a mainstream cryptocurrencies. And then Bitcoin reaches $10,000 as well. And the other two major events that happens from 2017 to 19, it was like pretty much mediocre journey for the Bitcoin and all the other alternative coins. Price goes up and down. But in 2021, it got like a lot of momentum after Tesla bought 1.5 billion worth of Bitcoins, right? And during that time, the Bitcoin prices has went up from 35,000 to 50,000. Now it's like closer to 56,000. But there's one problem here, as you may see. So as a strong believer of Bitcoin as a cryptocurrency, right? So for me, cryptocurrency is a currency. There should not be a valuation behind it. There shouldn't be. We should not be looking at the price of this the cryptocurrency as an asset, right? Because soon as it has become an asset, what happens is the price is going to go up or price is going to go down. The volatility is going to be extremely high. Then obviously people cannot use this one as a currency anymore, right? Because that is the story with Bitcoin right now. Because Bitcoin or many other cryptocurrencies, people cannot use this one. People like start using this one as an investment vehicle, which is also wrong, because there are no intrinsic value for most of these cryptocurrencies. It purely driven by the supply and demand, right? So it actually defeats the purpose, that the reason that we created Bitcoin back in 2008 to have an alternative currency. But now it has become an asset, right? Alternative asset. So people like start buying this one with the expectation of selling that in a higher price, right? So it's like a pure price game, no valuations, right? So it is in vain. Unfortunately, that's a reality today. But I mean, I'm hoping, as I said, as a strong believer of cryptocurrency, I mean, I have not say, I think, as I said, I bought my Bitcoin portfolio back in 2012, and I bought some in 2014 and 15 as well. And I didn't even sell. I mean, I sold some of my Bitcoins, but I think less than 10% of my portfolio, because I'm a strong believer of cryptocurrencies, and I really don't. I hate to see the prices goes up to $1 million or 100,000, even 50,000, because that should not be the case. Because they should the cryptocurrencies should be a currency, and the accessibility has to be very fair, very practical. Anyone should be able to buy and sell like have the access to Bitcoins, and then obviously should be able to use this one as another currency. But that is not happening right now, because people use this one as an asset. So So when it's come to cryptocurrency, there are a couple of things we need to understand, the dynamics and the features and the functionalities and some characteristics, right? So if you look at the entire cryptocurrencies market, there are two main types. One is the cryptocurrency and the other one is tokens. So the cryptocurrencies are the tokens that actually act as a currency, which has a store value or medium of exchange. Things like, like a Ripple or Bitcoin is the main one. And then obviously we have Ripple, we have Zcash, we have Monero, etc., etc. So we purely try to use this one as a currency or medium of exchange or like a store value. But unfortunately, like again, like if you look at the Bitcoins, you cannot necessarily tell the Bitcoin has a store value, because I mean, obviously today it could be 50,000, tomorrow it could goes to like $1,000. I mean, I will explain that why and how. So because of that, people cannot actually, I mean, keep this one and use this one as a like a store value. But like gold, yes, you can, right? I mean, yes, there are some price fluctuations, but not drastically, right? I mean, you can see, I mean, maybe like 1%, 0.5%, 2%, maximum 300 bips, right? But in Bitcoin, you can see a price fluctuation within 3 minutes, like 20%, 30%, even like 50%. So, I mean, some people, I mean, they're like a strong believers of Bitcoins or the cryptocurrencies. They say, yes, it does have a store value, but for me, in fundamentals of finance, there is no such thing, unfortunately, because of the huge price volatility that we see in the cryptocurrencies. So that's the cryptocurrency. So that's what we've been saying starting from 2008 to 2013. But starting from 2013 and 14, when the Ethereum blockchain became popular, there were a thing called tokens started coming into markets. So tokens are a type of cryptocurrency, but not necessarily a cryptocurrency, because it does not necessarily have a unique underlying technology itself. So what it does is it operates on top of another blockchain, right? Because if you look at the token markets right now, or the entire cryptocurrency market, when you call it cryptocurrency market, you have a pure cryptocurrencies and tokens as well in this market. So there are so many tokens that are built on top of the underlying blockchain technologies, right? If you look at Ethereum, there are so many other tokens that are built on top of the Ethereum, right? Ethereum blockchain, right? So those ones actually behave mostly like the underlying blockchain technology or the underlying cryptocurrency, which is Ether. And it actually can also hold value or can be exchanged, right? Because those are fungible. And then those ones can actually designate to represent certain physical assets or digital assets as well, but mostly for utilities or services. So the reason actually tokens came into the market is because, as I said, when this whole the blockchain saga came into play in 2014 and 15, especially with the Ethereum, right? So people like start using Ethereum blockchain to build so many applications, which we call dApps, right? So when they start building dApps or these applications, in order for them to raise capital, or in order for someone else to get the access to this particular project, they have to buy tokens. So that was the medium that they have created. If you wanted to use the service of my particular product or my app in a simple language, you have to buy the tokens. So by buying my tokens, you would be able to get the access to my particular service, right? So that was the whole reason of creating the tokens, just to get the access to your utility or service. But sometimes again, like people like starting to use this one, not necessarily to get the access to this particular service or the utility, but to use as a store value, just again, like as another investment vehicle. So that's the key difference between cryptocurrency and tokens. Cryptocurrencies are purely for payment purposes, but tokens are not necessarily for payment purposes. Sometimes, it can be a payment purpose as well if the buyer and seller are willing to extend this one as a payment services, but mostly to get the access to your particular product or service. And then, so we talked about how the cryptocurrencies came into market and why it was created in 2008, and then what was it about, what was the journey. So let's talk about what are the importance of cryptocurrencies, why we think it should be here. So unfortunately, we live in a world which is not necessarily perfect, right? I mean, there are so many geopolitical issues, financial issues, etc., throughout the world, right? I don't know whether you can remember back in 2008 and 9 and 10, and then again back in 2007, 16 and 17, those during those times, there were like at least, like 20 plus countries who were actually offering either zero or negative interest rates for people's investment. Things like countries like Japan, Germany, etc., etc. So people have all their savings in these banks, but they have on like either like zero interest, or otherwise they have to pay interest for the banks to hold their money, right? So that was one of the one of the key struggles. Like most of the people who are living in the Western world, whenever financial crisis happens, their interest rates, their interest rates that they get from the banks, it's going to go to negative or zero, right? Which means they won't earn anything. And then obviously there are certain countries like Venezuela and Zimbabwe, right? I mean, as you may know, right? These countries, and even Argentina as well, for decades, they've been experiencing like huge hyperinflation, right? I mean, sometimes people have to bring like a full of wheelbarrow cash, right, to buy a box of matches, right? That was like a real scenario in Zimbabwe, right? They actually have to think of like protecting the wheelbarrow, not necessarily money, because the wheelbarrow is actually more valuable than the money that you have in the wheelbarrow. So things like that, because of the inflation, obviously all the cash that they have in their savings, there's no value in it. All these things are due to like bad monetary policies. And the countries who has like high debt to GDP ratios, right? I mean, what they do is typically when they have a high debt payments to made, they actually print more money, and they try to create artificial inflation as well, because then obviously you have to pay less money when it's come to the repayment times. But then what happens is that the inflation effect, it's going to affect on your savings, right? Because obviously you're not getting enough value for your wealth or your assets that are held in the banks. So that is also another problems that we are seeing in the financial institutions, right? So all these reasons actually triggers people to have an uh, alternative method or alternative way to preserve their wealth or their savings, right? People were like thinking of, okay, what we can do if this is what's going to happen when we have bad times, right, or difficult times in the financial crisis, then how could we protect our investments or our wealth or our savings, right? So people like start questioning, and the cryptocurrencies could be the answer, because the cryptocurrencies typically is not correlated to the market, right? It's very much like gold. It's actually better than gold, because the gold has like a uh, we call like minus one correlation to the market. When the market crashes, the gold price goes up. When when the market is doing good, the gold price comes down, right? But in Bitcoin, it doesn't even act like that. It's like totally independent from the market conditions. So that is one of the beauty of cryptocurrencies. It's totally uncorrelated to the markets. So which means if there is any uncertainty happening in the market, you can transfer your assets or your wealth into the cryptocurrencies. But then again, in a perfect world, unfortunately, cryptocurrencies also have like a lot of price fluctuations. So in practically, you have to be very careful when you make such decisions. But there are a couple of other advantages as well. Like cryptocurrencies, those are borderless, right? I mean, if it's a fiat currencies, if you have US dollars or Sri Lankan rupees, it's going to be very difficult. I mean, like right now, right? I mean, you cannot transfer your money, Sri Lankan rupee monies to a foreign country. It's going to be very difficult because there are so many restrictions. But if you have like a cryptocurrencies, there's no such thing, right? Because it's an internet protocol from one wallet to another wallet through exchange or through a hard wallet, through a soft wallet. You can just like, transfer it within just like a second if you do it right. And then right now in the world we have 7 billion people. Out of these 7 billion, at least 4 billion people does not have the access to the finance because of they don't have bank accounts, right? So for all these people, the cryptocurrency could be an alternative, because cryptocurrency is all about peer-to-peer interactions, peer-to-peer payments, right? So if the cryptocurrencies comes in mainstream, I mean, for the people who are non-banked, this is going to be very beneficial, because they don't have to go through the entire banking system due diligence, because some of these people, they don't even have their birth certificates or any identifications, right? Some people are like, I mean, their literacy rates are extremely low, right? But then I mean, if they have to go through the bank traditional banking system to get the access to the financial systems, it's impossible. I mean, that's why we are in 2021 now, and there are 4 billion people who does not have bank accounts, right? that problem can be solved by having these cryptocurrencies, because it's purely decentralized and it's purely like peer-to-peer, right? And then obviously it's going to be that compared to like Master or Visa or any other transaction methods, the transaction cost could be like very minimal as well in cryptocurrencies, and it could be much faster. So all these reasons, right? Actually, when you take into considerations, cryptocurrencies has a lot to do, and there's a big say, right? And there's a demand. There is a demand, and there's a reason for cryptocurrencies to stay in our financial systems. So given that, okay, now we talked about, what's the background and what's the history of cryptocurrency and what are the key types of the cryptocurrencies and key functionalities. So, okay, so we said, okay, it's not controlled by a central authority and it is not governed by a central authority, right? And it is not a physical asset. So then what it is and who actually make the decisions of these networks, right? In these cryptocurrency payment systems, right? So there are three key people, key sets of people. First one is the developers, and then the miners and the full node users, right? So developers are the people who are responsible for creating and updating the code of that particular blockchain technology of that particular cryptocurrency. So if you look at the Bitcoin blockchain, the developers in the Bitcoin blockchain, they are responsible for the coding and then maintaining that particular code, right? As an example, I'm a director of a NYU blockchain, and we usually we conduct a meetup called Bit Devs. Before COVID, it's like a once a month event, and we do it in NYU auditorium. We get like close to 500 plus developers all around the world. People come from Japan, Russia, China, you name it, from everywhere, all the like code developers in the Bitcoin blockchain, and they discuss about the upcoming developments and the issues, etc., etc. It's like very interactive and very highly intellectual like meetups. I mean, most of the things actually I cannot understand because it's too technical. But that is, those are the people who actually make the decisions of, how should the protocol move forward, or how should you maintain it, right? So those are the people who make some decisions. And then obviously you have miners as well. Miners means who actually mine Bitcoins or mine these cryptocurrencies, right? So a lot of time I may use Bitcoins, but then again, please keep in mind that I'm referring to the majority of the cryptocurrencies here, okay? So miners are the ones who actually mine these Bitcoins or other cryptocurrencies. So they actually run particular like specialized sort of computers, just to mine these tokens. And then obviously right now, if you look at the entire world, there are, this mining happens in a very large scale. There are things, things called like mining farms. So they run like thousands of computers in like one mining farms, and there are so many mining farms in countries like China and Russia and Argentina, Georgia, etc., etc. And what they do is, they actually form like a consortium, and then once they mine all these things together, they sell everything through these consortiums. So those are the miners. They actually have like a lot of inputs into these the blockchain technology and how these cryptocurrencies should work and how should it behave. And then obviously you have the full node users, where that's actually the network of the cryptocurrencies. They actually validate, send and receive blocks and transactions and maintain copy of that particular blockchain, which is the technology of this cryptocurrency. So most of the time, these roles actually mixed and match. So like most of the developers, they actually miners as well, and they actually full node users as well. And there are some miners, they actually act as a full node users as well. So those are the two most common scenarios. So developers, miners plus full node users, or otherwise miners plus full node users. That's what I have seen. So these are the people actually who make decisions about these cryptocurrencies collectively, right? Because as you may know, in order for you to make decisions and in order for you to deploy certain decisions, you have to have more than 51% of the power of that particular blockchain network. But then collectively, these people actually come and talk and discuss and make these decisions regarding the behaviors and the patterns and the consumer patterns and the maintenance of these particular blockchains. You may remember I talked about a hard fork before. I said, there was a hard fork happen back in 2016 in Bitcoin. The reason I'm explaining all these things, because in order for you to understand what is the whole landscape of the crypto currency world, you need to know all these things, because sometimes all of a sudden, you see some sort of cryptocurrencies comes up and you need to know the reason. I mean, why and what it is and what are the key characteristics. I mean, whether I should buy it, is it within my risk appetite, or is it something that I can have the access to a certain thing. I mean, you need to know all these things in order for you to make such decision. It's not about, just like looking at the price of the charts and then, buy or sell, right? It's absolutely not that. So you need to know all this information in order you to make like a strategic or like wise decisions. So there are two types of forks that happens in the cryptocurrencies world. We call it hard forks and soft forks. So soft forks are normally the software updates, right? I mean, you don't necessarily have to. So when the hard, okay, so the hard forks happens when within this the developer community, sometimes there can be a disagreement in terms of the size of the blocks or in terms of the latency, etc., right? So typically when it arises, they talk and they negotiate and they come to a consensus, right? But there are certain scenarios they cannot come to a consensus. Once that happens, what happens is they decided to go split their blockchain into two ways, and then obviously the one team actually follow the old rules and the new team follow the new rules, but the new rules cannot be implemented in the old rules. So because of that, they have to find their own path. So they have a one common road, but then obviously at some point they're going to start going into two different paths, right? So the classic example is Bitcoin and Bitcoin Cash, which happens in back in 2017. So there were certain people in that blockchain committee. They said, size of the blocks has to be bigger than what we're doing right now, and the other people did not agree, but they couldn't come to a consensus. Then they said, in that case, we're going to go with the Bitcoin Cash. So it became hard fork, because the old the blockchain protocol has become two new ones, right? So that is hard forks. But sometimes there are soft forks as well, which means like some sort of a software developments, which actually some people does not necessarily have to be does not have to agree for that particular changes or the rules, but it does not necessarily affect the fundamentals of the blockchain itself. So because of that, actually it can go as one blockchain. As an example, some people can say, what, I mean, as a developers, we are not interested in like solving problems like mathematical problems that has value less than $1,000, right? If that is the case, they can set certain rules and they can say, I mean, I don't want to touch any blockchains that are not, I mean, the transactions that are not necessarily less than $1,000, and they don't put those ones into their blockchain, right? So that's going to be a soft fork, right? So they can execute it and they can have it in their local environment, but then obviously it does not necessarily impact the entire the blockchain itself. So those are the hard forks and soft forks. If soft forks happens, you don't have to worry about anything. It's just like you're getting another software update in your Android phone or like iPhone, right? But if it's a hard fork, then depends on how you hold your asset. Sometimes you can have the new asset as well as the old asset in your wallet, or sometimes it really depends on where you bought this one from, or otherwise where you keep your assets, right? As an example, when this Bitcoin Cash versus Bitcoin happened, Coinbase, one of the most prominent exchanges called Coinbase, they have decided to credit the people who own Bitcoin. They said, what, don't worry about, if you have any Bitcoins with us in our exchange, we will deposit the equal amount of Bitcoin Cash into a new wallet, like that. It's really depends on where you hold your asset. But then obviously you definitely have two different cryptocurrencies when the hard fork happens. So now we touch upon the broad spectrum of the cryptocurrencies. So let's see what sort of a size and volumes that we're talking right now. So it's all started in 2008 with Bitcoins, but as of today, there are 9,423 different types of cryptocurrencies. This includes tokens as well, cryptocurrencies as well as tokens. And there are 369 exchanges that are dedicated for cryptocurrencies trading, buy and selling. As of today, the market capitalization is almost approximately $2 trillion. And last 24 hours, the volume wise, they have done through all these exchanges and through these blockchains, they have done close to $190 billion worth of transactions. So out of all these numbers, Bitcoin still dominate, and it's more than 50%. It's like 50% to 50.2%. The size of the market cap is dominated by the Bitcoin, and the second largest is Ethereum, which has a 14.1%. And there are 71 digital wallets across the globe. So it doesn't mean that 71 people own digital wallets, because some people have, like multiple wallets, 3, 5, 10 wallets, right? But at least, 20, like not 10, 20, 15 plus million people, I believe, have digital wallets, which means, people, they use digital currencies. So compared to the security market, even though it is big, it is not big enough for the central governments or the governments or the central financial institutions to pay a lot of attention. Because as you can see, in the global context, the global bond market is 130 trillion, right? Compared to 2 trillion of the cryptocurrencies. And the global stock market is 100 trillion. These are like base as of end of 2020 after the COVID. So typically, I mean, back in 2018, I remember the global security market, the size of the global security market is closer to 300 trillion, right? So compare this one, right? The cryptocurrencies are like very minimal. So that's why you don't see that much of a regulation comes into play, because there are many bigger problems that the governments and the central financial institution has to play with, right? But if this market cap has become like $10 trillion or 15 or $20 trillion, then obviously all the governments and the central banks, etc., they would do everything there in their power to, just like either get on with this, but this new phenomena, or otherwise, put some break on it, right? But at this point, yes, they put some sort of regulations, and there are so many self-regulations as well. But then obviously you won't see that much of regulations comes into play until this one comes, and this 2 trillion goes up to maybe like 5 to 10 trillion dollars. So now, this is the most common question that we usually get, when we talk about the cryptocurrencies. Okay, what is it? Is it I mean, before we understand what these cryptocurrencies are, right? So let's talk about, what are the investment types as a general person. I mean, like a citizen, right? I mean, what sort of an investment vehicle we have, and what sort of investment decisions that we can make, right? So there are four main categories classifying as investments in the security markets. The first one is called security assets, right? These are the stocks and bonds, right? Equity, we call equity, and debts, or like stocks and bonds. So typically these ones generate cash flows, which means if you have a cash flow, then obviously you have an intrinsic value, because what you can do is, based on the cash flow and based on the projections, you can value that particular product or the asset or the security, right? So which means you have an intrinsic value, right? So it has a value. So for the security assets, so you have to remember this one this is very important. For security assets or the bonds and stocks, right? It can be valued. It has a value based on the cash flow, right? And it also can be priced as well, because you can do a lot of comparison with the similar assets in the market, right? Again, it's with the stocks and bonds, and then based on those comparison, you can price those assets as well. So there's a value and there's a price. So the value always comes from the cash flow, and the price comes from the supply and demand. So the security assets, you can see both components, value and the price. And then you have the commodities, right? Things like, like oil and gas, and then agricultural products like, wheat, rice, etc., right? Or silver, metal, etc. So these are like raw materials that can be that usually used to meet another need, right? So you use the what you call the oil and gas to produce energy, right? You use like the wheat and rice to produce food, right? So these are the commodities. So commodities can be valued, but it's a very complex method, because I mean you have to uh, go through like a lot of historical supply and demand volumes and etc., and then uh, you can come to a certain conclusion about the value, but it's a very difficult one. So that's why most of the time when you ask about commodity, right, you will always tell the price of the commodity, but that price always comes with the the prices, right? Because if I ask whether what is the price today, you look at the price today of the oil is, if you like say like $75, and you said it's going to be like $10 about the 3 months roll in, which means 3 months before your, I mean the price of the barrel of oil is $65, now it's $75. So you always compare that one with the historical prices. So in commodities, you always, like 99% of the time, you always stick with the price, not the value. So you can calculate the value, but it's a very tedious and very complex process, because you have to like you have to evaluate the entire reserves in the world, and then obviously go through the entire history of the reserves, and etc etc. So the price actually dominate in the commodities. Currency absolutely cannot be valued because currencies does not generate any cash flow, but it can be priced against the other currencies, right? As an example, so Sri Lankan rupees today we said 205 for one particular $1, we spend like $206, 206 Sri Lankan rupees. So currencies always can be priced based on the supply and demand, but there's no value because currencies does not generate cash flows. And then obviously you have the others, like things like collectibles, right? I mean, like art, and then etc etc. Again, for these ones, they does not have the values because these particular things do not create any cash flows, but it can be priced based on the scarcity and the desirability, right? I mean, if you look at go to an art auction, right, then obviously most of the time, right, all these like premium art auctions, they just like sell particular arts, and there's only one original arts, right? So the scarcity is absolutely 100%. And then the desirability of buying these ones comes from like a very elite people. So once this scarcity and desirability meets, it sets the price, right? So again, for the collectibles, those things can be priced, but there's no value. So just to summarize, security assets, you have value, you have price. Commodities, it's mostly price. Currencies, definitely only the price. And only collectibles, same thing, only price, no value, right? So no one can say it's good or bad if it only has value or the price, right? So those two things are two different characters, right? In this particular in these investment vehicles, right? So you need to understand whether my instincts or my risk appetite or my perception aligns more with the value or the price. So it really depends on what you want, right? Nothing is good or bad. It's two different things. So now we need to decide, okay, in that scenario, cryptocurrencies, are they a security, or are they commodity, or they currency, or is it something else, right? Collectible. So definitely, as of today, it definitely does. I'm talking about not the tokens, I'm talking about the cryptocurrencies, things like Bitcoin. You definitely cannot consider these ones as security assets because the Bitcoin does not generate cash flows, right? It does not, I mean, we cannot consider these ones as commodities because it does not use to make another need, right? Because you use Bitcoins and Zcash and more things like that only to purchase as a medium of exchange, right? So in that scenario, I mean, it has to fall into the currency, right? So this is, I mean, obviously when we created the Bitcoin back in 2008, right? So that was the whole purpose actually to act as a currency. But again, unfortunately, this is not happening right now because people are trying to put this one as a security asset, and then the price goes up and down without knowing exactly the fundamentals of finance. So now a lot of people ask us, I mean, okay, whether we should buy, or I mean, what we should do with the Bitcoin. I mean, the price goes up, etc., etc. It really depends on what you wanted to do. Are you wanted to be an investor, or are you wanted to be a trader? Do you have the right skill set to become an investor, or are you more in line with like a trading person, right? So the key differences between this investing and trading is like underlying philosophy of investing is the price. No, actually, I made a mistake here. Sorry. Price rejections, yeah, invest price. So this in this table, the headings should be interchanged because the things that I have listed under investing has to be under the trading. Because if you wanted to do, if you only concerned about the price, and if you only look at the price directions and market momentums, and if you only concern about the supply and demand, and if your interest is all about short term making money, and you are very, I mean, you like to act very quickly, and you have like a gambling instinct, right? And then if you believe you have a lot of money, so because of that you can make some market movements by buying things in large volumes, then definitely your perception or your risk appetite fits into the trading category, right? But if you are more or less like um, care about the intrinsic value or the fair value of that particular currency or the particular product, or and then obviously if these tokens, or if these particular tokens have cash flow or growth and risk, and if your risk appetite is more like medium and long term, and if you have a faith in the market, and if you have the patience, and if you can bear the peer pressure, then obviously you are more or less like an investor. So in that case, you can pick your investment into certain tokens that actually generate cash flows, right? As an example, there are so many Ethereum-based products or projects comes into market which actually generate cash flows, right? So in that scenario, if your interests are aligned with what I just mentioned, then obviously you should be thinking of buying those particular ones. But if your interests are purely for the pricing game, and the market momentums and short-term gains, then obviously you need to think of becoming like a trader, right? So those are the two key differences between the investing and trading. So based on these things, you can decide whether what you wanted to do. So type of cryptos, again, you need to understand the functionalities of cryptos, then obviously you can, again, like you can make the right decisions, right? So there are three main cryptocurrencies. First one is payment tokens, and the utility tokens, and the security tokens based on their functionalities. So the examples for payment tokens are like, Bitcoin, XRPs, which is Ripple, and then Tether, LTCs, Zcash, Monero, etc., etc. So these things actually, we only use these ones as a payment method. So which means these are payment tokens. These are like pure cryptocurrencies. Then we have a utility tokens, right? Things like Ether, EOS, etc., etc. So people can buy these tokens, but then obviously people buy these tokens to have the access to a certain utility, right? Because if you buy Ether tokens, then obviously you have the access to Ether blockchain. Then obviously on top of Ether blockchain, you can build certain product and services, right? So it's these type of things, we call it utility tokens. So what happened in 2017 was 2016, when the whole ICO thing became as a saga, right? Everyone start calling their tokens as a utility tokens, not as a security token, because then obviously you can get away with all the SEC rulings, right? But then obviously SEC, Security Exchange Commission in the US, has put certain rules and then tell, okay, just follow these protocols, and if your thing checks most of the boxes, then it has to be a security token, not a utility token, right? If it is a utility token, that means, once you buy this one, then obviously you have the access to a certain product or service. On top of that, you can build something in it, right? And the third one is a security token. Security token means, you can give certain, there's an underlying asset, and there's a certain collateral behind this particular asset, right? It could be some sort of asset, or it could be a cash flow as well. As an example, right, you can build security tokens for real estate or equity, debt, arts, etc., etc. So if you wanted to trade any of these particular traditional products, things like, real estate, equity, debt, what you can do is you can issue security tokens on behalf of that. So what it does is, if someone buys the security tokens, that gives that security tokens carries a certain ownership of that particular product or the security, right? So that's why we call it security tokens. So there's a very clear differences between the payment tokens, utility tokens, and security tokens. I hope that's clear. If you have more questions, we can discuss it later. So as I said, in 2016, there was a big hahoo about the security tokens versus utility tokens, because if it's a utility token, then you don't have to go through the entire SEC, Security Exchange Commission filing process. But if it's a security token, then obviously you have to go through that painful, because then obviously your security token is just another security. So which means, it has to be governed and controlled by the Security Exchange Commission, right? So then what the SEC did was, in 2016, they said, there was a ruling came out in 1946, which called Harvey test, right? If your token act as an investment contract, then it is a security, then it has to go through the SEC guidelines. So how do you decide whether your token is an investment contract? If it is an investment of money, and if it is in a common enterprise, and if the investment contract is with the expectation, you create this one with the expectation of you invest money in this particular thing with the expectation of profits, and it to be delivered from the efforts of the others, then obviously this is going to be a security. But if you do not fulfill these four criteria, then obviously you can decide your one is a utility token. So SEC said, okay, these are the criteria. So make sure your tokens are not falling into these four different characteristics. If it does, then obviously it is going to be a security token, which means you have to go through the SEC, and it is a security token, and it is just like another equity, right? Like a stock or bond. But if it is not, then obviously it's going to be a utility token, which means you don't have to go through the entire the reporting and governance process through these centralized bodies. Okay, so that's the main difference between security token and utility token. Because if you try to buy a cryptocurrencies, right, one of the questions that you need to ask whether it's a security token and whether it's a utility token. Because if it's a security token, you get like a lot of reportings, you have a lot of visibility and transparency, right? Because they have to report these things in a regular manner to the central bodies, and they audit these things. But if it's a utility tokens, you may not necessarily get that kind of transparency, right? So it's purely based on the trust that you put in place into the protocol, right? So those are the key differences between security tokens and utility tokens. And the level of crypto ownership, right? So there are different levels of ownerships that you can have, because sometimes people do not necessarily want to have the exposure to the entire cryptocurrency itself, right? Because there are certain pension funds, there are certain institutions, right? Mostly in the Western world, they don't like to hold cryptocurrencies in their portfolio, but they like to get the exposure to the price of the cryptocurrencies just to diversify their portfolio, right? So instead of buying the entire cryptocurrencies, what they do is they buy crypto trust shares. So one classic example is there's a company called Grayscale. So they introduced a particular product called Grayscale Bitcoin Trust. So what they do is they put a lot of the Bitcoins into one pool, and then they create an SPV or like a special purpose vehicle, and they issue the shares of that particular SPV. So certain institutions like things like, pension fund, hedge funds, and et cetera, if they only wants to get the exposure to the price, they buy these shares rather than buying the cryptocurrencies, right? They buy the shares of that particular SPV, right? So by doing so, you don't necessarily own the cryptocurrencies, but you get exposed to the prices. Sometimes, you can buy these things through exchanges, right? So once you buy through the exchanges, then obviously you have two options. One is like you can transfer it to your own hard wallet, or otherwise you can keep it in the exchange. But then obviously the maintenance things are much easier, because obviously you don't hold it in your own wallet, so you don't have to worry about it. But the problem is it's going to be in a central location, which means it can be hackable. And then if something happens, and if someone hacks, and if the exchange got hacked, and if the tokens are gone, your investment is gone. So that is the key risk of keeping your tokens in the exchange, right? So my advice is, if you buy something to an exchange, make sure to transfer it to a soft wallet or hard wallet. So again, so this in the exchanges, if you keep those ones in the exchange, you own it, but you don't have it physically within yourself, right? Because it's kept in the storages of the exchanges. And then you have the soft wallet. Soft wallets means the online storages, right? There are so many companies like Gemini, Zappo, Electrum, et cetera. They provide online wallet services or storages. So what you can do is you can buy it through exchanges, or like through peer-to-peer transactions, and then you can keep it in these online storages. You just like open an account and then you transfer it. Again, these are not necessarily with you physically, but these are in online storages. And then you have hard wallets, which means you have certain like a pen drive, that sort of like a product. You can just download it, and it's offline, and you can always keep it with yourself, right? So the advantage is no one can. It is within your possession, but the problem is if you misplace it, or if you lose it, it's gone. Obviously it's like you put some money into your wallet, and then for some reason you lost it. So things like that. So these are the 4 types of key ownerships of the cryptocurrencies: crypto trust shares or exchanges. You can keep it in the exchange, or otherwise you can keep it in the online wallets, or otherwise you can keep it in the hard wallets. Okay. And there's a new token came in again. Like now we can talk about different types of derivatives of the tokens, right? So cryptocurrencies. So there's a new thing came into market a couple of years ago. Things called non-fungible token. So then the reason the non-fungible token came into market is because most of the cryptocurrencies are fungible, just like US dollars, right? If I give you a $1 bill, and if you give me another $1 bill, it doesn't matter, because it's still $1, right? We don't care about what is the serial number, etc., etc. So like that, most of the cryptocurrencies are fungible. But then obviously when it's come to securitization of certain assets through cryptocurrencies or tokens, right? Things like real estate or art or vehicle ownership, right? So it has to have like a certain like a unique identification, right? So because of that, this non-fungible token mechanism came into the market. So when you tokenize your particular product as a non-fungible tokens, then obviously it is very unique, which means no one can exchange it. You cannot use this one as a medium of payment because it actually carries a certain properties in a certain product, right? So by doing so, you actually preserve the ownership and the originality. So that is the key thing, because there was so many. Let's take an example, right? When you take like a digital copy of a photo or something, right? People can create a lot of copies and no one knows exactly what is the original one, right? But if you entail a certain tokens with a very unique data into it, right? And then once you buy that particular digital file, if it comes with that particular unique identification that has the original code, then you know that this is the original one. And there's only one original one, right? So that is the reason actually the crypto market introduced a non-fungible token, just to give that particular feature which preserves the ownership of a particular product or a security. And there's another type of token called stable coins, right? So the reason that the reason that people created the stable coins is to avoid the price fluctuations, right? Because as I said, right, starting from 2013 all the way to 2017, right? If you look at the Bitcoin prices and the other cryptocurrency prices, the prices are pretty much all over, right? So then it became a problem, right? Because if some of the big financial institutions, they wanted to get the exposure to the cryptocurrencies because it's a different asset class, which does not have the correlations to the market. So it's very important for them to have some sort of exposure to this kind of asset class. But then again, they cannot do it because of the volatility of the price is insane, right? So because of that, actually the stable coins came into market, so that the difference between the stable coin and any other cryptocurrencies is like, stable coins are always pegged to a certain outside product, such as, dollars or gold, right? And these are like asset-backed security, and it is 100% fully collateralized by the underlying asset, right? And assets are stored in a reserve. So as an example, the best example is Tether. If you buy like one Tether, it's pegged, it's always, equal to $1, right? If you buy one Tether, you always have $1 in the reserve. So if you wanted to exchange it to a the alternative asset, you can always do that, right? So it's always pegged. So because of that, now though a lot of these financial institutions, actually they can buy these stable coins and they can have the exposure to a cryptocurrencies which are not necessarily correlated to the market conditions. But then again, right, what they need to understand is like, if they are pegged into a certain currencies like US dollars, right, when the market collapse, right, then obviously it can definitely impact on the prices of the US dollar as well, which means it's going to impact on the that particular stable coin, right? So these are not necessarily like very black and white answers, because all these market products and all these approaches are very new. So people are like introducing and testing these things in the market, whether it's going to work or not. So we don't know whether this stable coins concept, whether it's going to work or not, right? So far it actually worked into a certain extent, but we'll see. Time will tell. So the million-dollar question, are we seeing the mass adoption, and why? The Bitcoin and the blockchain itself in the market for more than a decade now, because it started in 2018, right? And are we seeing a mass adoption? Absolutely not, right? So then that begs the question, what's the problem? Why is it not becoming a mass adopted currency or product, right? First one is, there's like an inertia, right? People think, right? People always, think, if it's a currency, if it's a monetary instrument, right? It has to be an instrument that is issued by the government, and it has to have like a physical form, right? Paper or coins, right? So that kind of perception is still there, like with the majority. Not with the new generation, most like like Gen Zs and afterwards, but with most like the baby boomers and Gen X and not Gen X, baby boomers and millennials, right? They still think if it is a monetary instrument, then obviously it has to have some sort of a government shape and form with like a physical paper and coins, right? So until that perception changes, it's going to be very hard for the cryptocurrencies to become a mainstream currency. And the second biggest challenge is the price volatility. As I said, as long as people treat this one as an investment vehicle, there's no way that you would be able to get rid of this particular matter, because you always see the price volatility, right? The problem is there's no intrinsic value, so it's just like, people just like buy and sell these ones with the expectation of selling this one at a higher price, right? So because of that, you will continue to see this price volatility. But the problem is, it can even go to right, as of today, it could be 56,000, and it can go to 20,000. But if anyone asks me whether it can go to zero, technically yes, but practically no, because all the people who put their sweat and blood into these Bitcoin blockchain protocols starting from 2012, there is no way that they would allow to make it happen, because obviously if the price is going to come down, they always just uh, buy and sell the Bitcoins, and obviously make sure that the price is going to keep in a certain range. I don't think it's going to go to zero unless the entire world or the major countries like US or European countries ban the Bitcoin entirely. Then the prices can go to zero, but not as well, because then obviously people like start using this one in a dark web a lot, and then again like, it will create a certain price game, right? So it's going to be very hard to believe that it's going to go to $0. And the third one is like there are so many competing cryptocurrencies. As I said, right, as of today, there are more than 5,400 cryptocurrencies. So no one knows what's going to be the king of the cryptocurrencies, right? Until that happens, obviously there is no winner, right? I mean, as of today, yes, it is a Bitcoin, but there are so many limitations in Bitcoin as well, right? There are only like 21 million supply in the Bitcoins, and no one knows whether if the majority of the network decided to increase in the supply, what would happen, right? So there are certain uncertainties. I mean, it is stable. It performed well for the last 12 years, 12 plus years, but still, it is not necessarily the king of the market, and it did not earn the trust from the majority of the people in the world to act as a global phenomena, global currency. So because of this reason, the acceptance of these cryptocurrencies as a currency is like very slow, right? But I think it happens surely, but slowly, right? It might take another 10, 15 years time, and it may not necessarily be a Bitcoin, it may not necessarily be Ethereum, right? It could be totally different digital currencies. But I'm a strong believer of digital currencies or cryptocurrencies, like a decentralized cryptocurrencies, and I strongly believe that is going to be the future. But timing wise, I don't know when that's going to happen. So that is that concludes. I mean that concludes my presentation, and I know that you have so many other questions and comments and feedbacks as well. So I'm more than happy to discuss the other matters and things that comes into your head, and let's have a like a two-way dialogue.